Hey, good morning. This is Vance out of the Seattle area. It's Thursday, May 5th, 2016. I'm a little bit later today on the session. Had some things this morning I had to do. But anyway, let's get to it. In fundamentals today, the U.S. labor market, anyway, the word is that it's solid and consistent. Basically, one of the things that I saw is it hasn't made a significant loss. Put it this way, it's never been more consistent since 1973. Now I'm sure they had to grab some numbers from here and there to make that happen, but nonetheless, it did sound good when you read it. But that's the only thing I see. Keep in mind that tomorrow is non-farm employment numbers. On Wednesday, the private version ADP was about 50,000 jobs short of expectation. But again, those are private, more speculative numbers. So tomorrow, look for a fast move if the numbers are off by 60,000 jobs in either direction. That's it for fundamentals this morning. As far as price movement, let's talk about yesterday a little bit. There's not anything to talk about. I showed up yesterday. I showed you it was just really choppy all over the place. The patterns were all inconsistent, not at all what we're used to seeing. And so I said, I wouldn't do anything. And it's been a while since I showed up and just did that. Now, today, you'll see me talk a lot about orders and price resolution. And you can see a line here as price comes across. The buyers were only able to push it up to here, and then they lost a little strength here. And this creates what people refer to as a trend line, sometimes depending on how you do it, a supply line. But what it is you really got to think of it in terms of how many orders were there in that period of time. This is a 30-minute chart. So over a 30-minute period, the sellers were able to not only stop the buyers, but stop them lower each time. And then this ends up creating what some people symbolically call a channel, because on the bottom side you see the same thing. This tendency of the sellers to beat the buyers back a little bit more is showing the same angle of dissension on the bottom side, and that's where people say, well, there's a channel on the bottom, without really knowing what it means or how to use it. But it's really simple idea. How many buyers and sellers? What happened with the buyers and sellers over a period of time? And that's what we're seeing here. So a close, I would look for a 5-minute candle close right here just to show that something's changed. Now let's drop down to the 5 and take a peek at this. See if it still looks good. It does. It looks very good. So you see that the buyers and sellers are struggling in this range right here. This is where the battle's going at 77 pips of ground. And then if you see a change, like let's say it could dip below here and go back up, but if you see even a 5-minute period close below this, that would represent a change going back to about 6 o'clock in the morning yesterday. So since then, this is held consistently. This level is held consistently. Same thing on the top side. Little less attractive on the top side because you got some sellers probably in here as well. But down here, the sellers get through here, the buyers are just going to be discouraged. So it's a little better to the downside, plus the balance of money as far as trending is to the downside as well. Let's see. So let's pop over the euro. Oh, we got a move happening. So let me really quickly see if I can catch you up. So what I want to show you first is we have this move down. And I'm not sure I'm going to get there in time to take a trade for you, but we'll see. And now notice it pushes down, pulls back, pushes again. So the real starting point of this move down is here. And if you look at this and you mark it here, you'll see a 38.2 pullback followed by another push down. Now here's our change right here. You see this 5-minute candle? It closes below this level. This is what we're looking for. And I basically missed the bus by starting with the pound. Otherwise, we could have popped a trade right here on this candle close, maybe targeted about 10. And let me see if we would have got out of it yet. Yeah, we would have been just out of it. We could have even done 9 because look how close the entry is to the previous range that it broke out of. I mean, our stop could be anywhere from, let's say, again, we want to keep the stop up in this former supply area. And so if our stop was anywhere above here, we would be good. And we could have had our stop all the way up here. So technically, if we had enough usable margin in terms of trading a large number of contracts with a small stop loss, if we had enough usable margin, we could have gone with a quite small stop loss. But you know, the general rule is 8. A stop loss of 8 is going to basically max out your usable margin at 2.5% risk to equity. So so that would have been a good trade. I was just, sorry guys, I was just it looks like I was just maybe 30 seconds too late on that. Otherwise you could have seen me doing that. But what I would have done is when that closed, pop sell trade, put the stop, I would have gone for probably 9 and then just move the stop up 9 1-to-1. If you're getting 1-to-1 profit, if you think about it, it doesn't matter if you get 100 pips or 5 pips, you make the same exact amount of money. So this is making profits is the most important thing, is being able to see an advantage on the part of the buyers or the sellers, know the strength of that advantage, and then to be able to manage the risk. In other words, how safe is the stop loss? How probable is the profit target? And then the entry point helps to balance those things out. You need a better entry to get a better stop, to get a better target, and so on. So anyway, just to let you know, if I'm talking over some of your heads, you just need to go to forexartofwar.com, get my free book. There's nothing to register for. You just go forexartofwar.com, click on this yellow area, and as you'll see, it doesn't ask for an email or anything, and you have my book, which what I try to do is capture 11 years of Forex trading and trading all in one book. And I think that you'll find that this is the most valuable Forex trading book you've ever read. So I don't mind. I believe that because I just worked so hard for so many years to help traders to learn how this works. Anyway, you can judge for yourself. It's free. Anyway, and I have nothing for sale, by the way. I retired about a year ago. I just continue to work a little bit, helping the traders that I was working with. I'm doing life coaching now, which I really, really enjoy. You know, a lot of the success in Forex trading has to do with psychology, and so I just naturally kind of evolved into human potential, and then decided to shift from Forex trading over to that. I just felt like I could, it would be more rewarding for me personally and more helpful to other people. Anyway, that's about it for this morning. Now, be careful not to jump on a moving bus. Now, another thing that you could do here, I guess I got one more thing. I'm going to go ahead and get rid of this fib. And you'll understand all of this when you read my book. But I'm going to check this move here, which begins here and goes to here. One of the things you could look for, as long as this is, 18 or more, you could actually look for a pullback to 38.2 or better. You don't want to jump in at 23.6, but here's your 38.2. Now, what's going to determine whether you get in at 38.2 or 50% or whatever? Basically, your risk management. I mean, where would you be most comfortable with your stop? Above 76.4 and in this range. So this is very obvious stop location right here. And then your most probable target is where the buyers and sellers reconciled over a 5-minute period, which is right here if they were going to pull back. Now they're not pulling back yet, but if they started to, this is your most probable target based upon this candle body close. And then you get in a situation where all you need is this to pull back for you to get a 0.75 to 1 or 1-to-1 risk to reward. Whoa, what's wrong with my voice? Risk to reward relationship. And then you've got all your bases covered. So that would be a good trade. And you could keep moving this, and eventually it would let you in at, lower and lower and lower. And of course, you have to keep adjusting your fib down to where prices made it to. So far, our optimal target is still here until a candle closes lower. So that's what you're looking at, and I'll leave you with that. You can watch it, but keep moving your fib to the lowest price before until it pulls back to 38.2 or more, and this is how you set up the trade. So with that, you guys have a great day. Again, watch out for non-farm tomorrow. Be very careful with that. If you're trading a demo account, jump in there and trade it. That way you get experience with hyper volatility. You get experience with how that affects spreads. You get experience with, the price that you get or can't get, rather. So, experience is much better than book knowledge. So, if you've never traded during non-farm, do it a few times in a demo account so you get a feel for what it's really like. Because a lot of people are thinking, oh man, I could get a quick hit. I could jump in. I could, maybe risk 30 pips and make 100 in 5 minutes and make a lot of money. That might be possible if you were able to get your order executed at the price you want, but you don't know that's not possible until you get in and do it. So, so I'd encourage you to do that. That's about it. You guys have a great one, and following tomorrow, have a great weekend, and I'll plan on being back here Tuesday morning. Thank you, and bye.